All right, here we go. So, huge news out today from the Fed meeting. Crazy day in the markets. This is a little bit different than my usual business react videos. We're going to be going into what that means that the Fed actually cuts rates, what that looks like for the overall economy, the real estate markets, the stock markets. We're going to talk into that. Graham Stephan just released a video on his main channel, which he never does anymore because he's tired of making content, unfortunately. 4 hours ago, though, he released this new video going over the Fed Reserve announcements and most likely when they're actually going to cut rates. Now, what's really important here is the timing of it and what they have said in this meeting. Because whether or not they cut rates today or are going to cut them in September, which they didn't come today, but regardless, whether they cut them or not, indicating that they're going to either cut them in September by a half or a quarter point or in October is basically giving a green light to the market to adjust for what rates will be in the next 30 to 60 days. So, going to be super excited to dive into this, what this means for the real estate stock market, and especially for your business. And if you haven't already, please subscribe to the channel. I try and keep you guys up to date as best as possible with best business practices, how to generate leads for your business, and how to invest the profits of your business into your future. That being said, let's just jump into the video. Like, so excited. I love Fed meetings right now. It's so exhilarating. So here we go.
It's Graham here, and without exaggeration, we're probably about to witness one of the craziest moments in history. For example, even though the Federal Reserve just announced another rate pause a few hours ago, the market believes that we could see the first rate cut as early as September. Politically, the market is bracing itself to be completely overturned, and with new proposals coming out on a weekly basis, including nationwide rent control, we should break down exactly what this means, what's likely to happen, and how this is going to impact you. Because I gotta say, despite what you might think, the stock market appears to favor one political party over the other with significantly higher returns. The housing market could be thrown for a twist, depending on who's in office. And the Federal Reserve is at the center of everything, with some brand new comments that you're definitely going to want to hear on this episode of Costco's now selling.
So, and he said a lot. I saw this fascinating TikTok video today breaking down the stats between the first year of an election cycle, whether Republican or Democrat wins. First year, Republican tended to do better. I've also seen other studies that show over the course of a presidency, Democrats tend to have better stock markets. Now, there can be a lot of things explaining why the economy does what it does. We typically follow a debt cycle of 4 to 8 years, of 8 to 12 years, which happens to coincide with a lot of presidential terms. The other thing that goes on, regardless of where you stand politically, too, is that the economy is super slow to shift between economic policies, and you can really see, like, whether you like the man or not, Obama had a very stagnant, I would almost say, first 3 to 4 years of his presidency, and you saw a lot of buildup, and you could argue Trump did a lot to throw fuel on the fire to get a lot of that explosive growth, the close to 5% GDP growth he got when he was president, versus what the economy was doing while Obama was president. We also put a lot of emphasis on the president and how the economy operates, but we've also seen the rise of the big seven, basically NVIDIA, Microsoft. I think Tesla's in there now, Apple, and I forgot the other one or two, but the really big tech companies that drive the majority of the market cap of the S&P 500 when you're looking at the trillions of dollars that they control. So, and that sways the economy heavily. And part of what Obama got, and arguably even Bush really didn't get it because most of his presidency was during the dot-com bubble. But really you saw the rise of tech, the rise of social media, the tail end of the browser wars during the Obama administration. Trump administration, obviously, you're looking at the back end of like B2B SaaS really starting up, the starting of the AI wave and resolution, and then all of that being cut drastically during COVID with a very rocky ride. A lot of stimulus money that's going to slosh around in the economy for years to come. And then also you just have the Biden economy, which has really seen AI explode, chip manufacturing, the power of compute, all of that. So regardless of who's president, the economy, in a certain sense, has a mind of its own, especially in America with free markets and entrepreneurs that don't care who's president. They only care, they don't even care if the sun's up or the sun's down. They only care what day it is and if they have time to work, right? A lot of these entrepreneurs, especially Silicon Valley based, work as close to 24/7 as they can to get their products off the ground and see if they have viability in the marketplace. So, and again, a lot of this is probably going to focus, as he mentioned, on this presidential election. There's a lot writing on it. The market had a crazy rally just a month or so ago when it looked like President Trump had a locked-in election. Obviously, there is some favor going to him and from investors on what the economy would look like. I think we've seen a lot of turmoil in the last 2 to 3 weeks because of everything from the assassination attempt to the hot swap on the Democratic side from Biden to Harris. There's just a lot of complexities going on in the market and how people think are going to react. Now, presidents and, of course, Congress can have a really they can have a large impact on the economy over multiple years based off legislation they pass, whether or not they open up national reserves of natural resources such as natural gas, oil, forestry, coal, all kinds of resources that are in the U.S. And that can really depend also on who is in office. Now, granted, the economy is much larger than that. The one thing I will say, regardless, is I think whoever becomes president, and I've seen this talked about more and more, but just trailing on, if we want to remain, and this gets really deep into geopolitics, what the future of technology looks like, but either way, I view that we are going to need more compute power than ever before. And in order to have more compute power, not only do we have to manufacture more chips, which we're building more manufacturing stateside for that specific role, but the other thing we need is electricity to power those chips. And I think it's actually time that America really revisits the conversation about nuclear power, regardless of who's president. And hopefully that can happen because in order to power all these chips, all of these data centers, where we're doing very heavy computational loads to train AI models, we're going to need a lot of energy to do that. And that, even whether it's AI or crypto or another solution, it is most likely going to be behind compute power. If you look at Moore's law, the whole idea of it and how they value tech companies from the very beginning, and what a lot of people, some of the most successful investors, if you look at Sequoia or Mercy, I can't remember the name of the other, Benchmark, the other VP fund, a lot of what they did was basing off of Moore's law, saying if we're going to double the amount exponentially of, I can't even think of the term, of compute power we have every year based off of the number of whatever we have on the chips. What are they called? I forgot what they're called. Mercy. Word is escaping my mind. But essentially, if we're doubling our compute power every year, we're going to be able to solve more and more complex business problems. And what we're looking at with different AI solutions, so whether that is a neural net, a recurrent neural net, a large language model, whatever it is, we're able to solve more and more complex tasks. And some of these, like with LLMs like ChatGPT, it's just increasing average worker productivity by 10 to 30%. Whereas some other things, where we're using it to remap or come up with different solutions for different compounds that we can use to treat different diseases, or even potentially cures to different diseases such as cancer, really exponential and potential productivity. And it's really interesting because we're at this phase right now where AI is a really new technology. Everyone's talking about, there's lots of buzzwords, but at the end of the day, you need lots of data. You need lots of really smart data scientists, machine learning engineers to really come together, data engineers, computer scientists to come together and actually make products that people can use to come up with these creative solutions. So it's kind of like the early days of adopting this new technology, and there's a lot of questions of how much will we actually be able to monetize AI. Anyways, I've gone on a long tangent. Back to rate cuts. That's what is important today.
Apocalypse-ready food buckets. Although before we go into that, as usual, if you appreciate me doing everything I possibly can to get this video out within a few hours of the Federal Reserve meeting, all I ask in return is that you hit the like button or subscribe if you haven't done that already. It's totally free. A big thank you to Cook Unity. Rate cut. We got to address the catalyst of everything, and that would be inflation. Now, even though consumer prices have risen on average across the board by 20.8% since 2020, there is some good news in the fact that prices are beginning to come back down. or at least not go up with such quick velocity. As proof of this, it was reported that prices in June fell for the first time since the start of the pandemic. And even though it was only a drop of 0.1%, the trend at this point is obviously clear.
The other crazy thing that we are seeing with inflation is we're actually seeing a lot of deflation across the boards, with multiple large consumer brands such as Target actually lowering prices over a large majority of their merchandise that they hold in stores.
Inflation is beginning to subside. In this case, you could see that all items increased at a rate of just 3% year over year. And if you remove food and energy, since those could be a bit more volatile, we're back to the same levels that we saw in early 2021. In terms of why this occurred, a 3.8% drop in gasoline prices certainly helped, but used vehicle prices also decreased by 1.5% on the month and 10.1% from a year ago, leading to the conclusion that inflation could finally be subsiding, higher interest rates could soon be coming to an end, and if this continues another few months, we could be in the clear for some rather substantial rate cuts. Or will we? Well, to break that down a little further, there's one topic that's never been more relevant than it is right now, and that would be the stock market. That's right.
Nothing dims my light like a migraine. With Nurtec ODT, I found relief.
The only migraine medication.
On the one side, we have Democrats, who so far have led the S&P 500 with a nearly 20% gain year to date, while on the other side, we have Republicans, with Trump proposing a massive corporate tax cut that could lead to another economic boom. So that got me thinking, who exactly is better for the stock market, Republicans or Democrats? Now, obviously, past results aren't always going to be indicative of what actually ends up happening in the future, and of course, a president doesn't have direct control over whether the stock market goes up or down, but surprisingly, there were some trends that I found rather shocking, so you're going to want to hear this. Over the last 100 years, only 3 presidents have ever experienced negative annualized returns of the S&P 500 over their term. That would be George Bush, Richard Nixon, and Herbert Hoover, who happened to be in office during the Great Depression. That's it. Beyond that, every other president.
Bush got a double whammy. He got the dot-com bust, and then he got the Great Recession. Herbert Hoover obviously got the Great Depression. Nixon had the crazy inflation of the 1970s.
Has seen some type of positive returns throughout their presidency, but oddly enough, election years tend to be the most profitable. As an example of this, over the last 100 years, the stock market has averaged an annualized 10.3% return. But if you isolate presidential election years, that jumps to a staggering 11.6% return. In fact, as it stands right now, investors are actually the most cautious around midterm elections, with the market increasing just...
Side feedback, I'm not defending any of those presidents, but I'm just commentating on what was going on in their presidencies, why they may have experienced negative returns of the S&P 500 during their terms.
7.4% compared to non-election years where the market averages 14.8%. Why, you might ask? Well, if there's anything an investor hates, it's uncertainty. And when the market can't price in the unknown, it tends to fall for the worst possible case scenario, which then lowers investor returns, especially when Congress has a much larger overall impact on the economy than the president does. Although in terms of which political party is better for the stock market, that really just depends on whose data you look at. For instance, Y-Charts found that the average Democratic president achieved an 8.72% return when both the House and Senate were a majority Democrat, a 15.72% return with a split Congress, and a 14.5% return with a Republican Congress. On the other hand, Republican presidents received, on average, an 11.7% return with a Republican Congress, 12.2% with a divided Congress, and just 1% with a Democrat Congress. So a Democratic president with a split Congress wins, right? Case closed? Well, not so fast.
So the wild thing in both of those is, like he said, split Congress tends to do better. Let's see what he says. I think that's interesting, though, at least according to this data set, that split Congress tends to do better. That's what I would, at least in my brain, ideally love to see, is where we're theoretically like the most united or split, like no one has complete control, is when we actually get the best returns.
Fortunately, the Republican President Hoover during the Great Depression significantly skewed the results to the downside, since an almost 30% annualized loss is bound to drag down the average. So if we just excuse that one data point, everything else begins to change. Like, according to the Motley Fool, since 1957, Democratic presidents have seen an average 9.8% return compared to Republicans' average 6% return. But Republicans have a median 10.2% return compared to Democrats' 8.9% return, which some could argue is way more accurate since this includes stock compounding. And if that sounds really confusing, just think of it like this. Ultimately, what it seems to favor is that historically, a divided Congress is best for the stock market, since that means any radical proposals are probably unlikely to go through. It's going to be more of the same, and if you're concerned about stock market returns, it's a lot more opportunistic to look at the House and the Senate, because they have way more control than the president. And at the end of the day, that's what really matters the most. Although in terms of how this could impact housing prices, here's where things get very interesting. Although before we go into that, look, I know we always talk about money and personal finance here on the channel, and of course that's never going away, but at the core, your time and health are way more important. ROI, and eat the right meals that not only with their spine freshly high quality and each week prepared dinner is done and also super flexible, cancel at any without paying to spend in line dollars a meal. Flank steak were under /gram50 and use the code gram50 at checkout for 50% off of your first order with the link also down below in the description. I've also said this before, but if you haven't tried it, at 50% off, it's probably way more affordable than what you're eating already, and it's absolutely. And now that, yes, it's no surprise that prices have hit another record high, rising 4.1% nationally from a year ago. But this time, they are rising at the slowest pace that we've seen since early 2023. At this point, the NAR chief economist went on record to say that we're seeing a slow shift from a seller's market to a buyer's market. Supply and demand dynamics are nearing a balanced market condition, implying that the days of massive price gains are probably behind us, especially now when it's cheaper to rent than own in all 50 of the largest US metros. However, in terms of helping the cost of rising rents, one proposal has begun making the rounds, and that would be nationwide rent control. Under this new proposal, the president calls on Congress to cap rent increases on existing units at 5% or risk losing current valuable federal tax breaks, and provide $10,000 in mortgage relief to unlock homeownership for millions of Americans. But is this actually enough to make a difference? Well, in terms of rent control, the honest answer is probably not, and if anything, it could actually make the situation much worse. For instance, here's what the current housing climate looks like. Half of American renters pay more than 30% of their income on housing, which, just for some context, is the exact same as homeowners spend on their mortgage, and 12.1 million Americans spend more than half of their income on housing, which, yeah, is a lot of money. But practically, like I mentioned earlier, rent control is actually found to make the entire housing situation worse. I mean, there are very few things that economists uniformly agree on, but a 1992 poll of the American Economic Association found that 90.
I still have a spreadsheet on my desktop that has 86 no's of it's
kind of interesting how he's framing this, and also like just the idea of rent control nationwide. The reason why I wouldn't be super duper behind that idea, just from like an investor perspective, and even though theoretically it could be good, trusting the government to understand every single market all the way back in Washington, D.C. probably isn't going to go the way that people think it is. Just like the idea of a minimum wage is a great idea, we've seen the fact that Congress hasn't really been able to keep up the minimum wage with inflation, which is why national minimum wage is still $7.25 an hour. And of course, that is not a living wage in 2024, like without a question of a doubt. Like, you just really can't. So the really tough thing there is figuring out the balance of if there is a way that the government could potentially help with this without, painting across the entire U.S. all of these different markets with really broad brush, which is most likely what would happen with a rent control.
3% of its members agreed that a ceiling on rents reduces the quality and quantity of housing. In fact, a more recent Stanford study found that rent control has an adverse effect on housing prices for tenants and does the opposite as what it's intended for. How? Well, they started by looking at two groups of housing. One built prior to 1980, which is rent-controlled, and the other is built after 1980, which is not rent-controlled. And here's what they found. Rent-controlled tenants were 20% more likely to stay in their unit. Renters were more likely to move somewhere else if they didn't have the incentive of keeping their rent capped where they currently live. In the priciest neighborhoods, turnover was the highest as landlords actively try to remove tenants to achieve market rents. Landlords of rent-controlled buildings were more likely to convert their buildings in such a way that wasn't rent-controlled, reducing the amount of housing supply by 15%, and the loss of available housing drove up the price of rental units. The net result is that, based on these studies, rent control restricts the amount of new housing supply that's able to come on the market, and while some tenants might get a great deal and win the lease agreement lottery, most people never have access to such affordable pricing. And if they do, they are incentivized to never leave or move elsewhere or risk giving up their price. Think about it. Just like low interest rates kept homeowners from selling because they don't want to give up their historically low mortgage rate, rent-controlled tenants also don't want to leave and are locked into where they're currently staying, thereby resulting in lower supply. On top of that, in terms of city revenue, rent controls are found to decrease income taxes as landlords make less money and therefore pay less in tax. It's also found that because of lower rents, properties had a lower value, which resulted in lower property taxes. And all of that is money that flows back into the community. Now, even though some corporate landlords are money-sucking vampires who only exist to extract as much financial value from unsuspecting tenants as possible, it was found that across the United States, less than 50% of landlords raised rent by more than 3%, with the other half raising rent by less or even nothing. Or basically, most of these headlines that we see are simply from an existing tenant moving out, a landlord renovating a property, and then renting it at a higher price.
The other thing that happens a lot of times, like you said, renovation, but other times you'll see these older, like especially multifamily properties that are between 4 and 6 units. A lot of those, they'll have like prices set at a certain rate, and they're being managed by someone older, and they don't raise their prices yearly because they have the property paid off, and it cash flows is like bananas for them, so they don't care. Now, what typically happens in those scenarios is that they will sell the property because they don't want to manage anymore. If someone comes in, they might renovate it, they might not, but they might say, hey, this place was renting for $550 a month, market rate's $800, I'm going to raise prices $300 a month, and that's where you get the crazy like 60% rent increase. And it's not necessarily that they're wrong in doing it, it's just the market. There was a divide between where rents were for the property and what market rates are. It's almost like a unimposed rent control, right? The one thing that I would say, and just from an ethical standpoint, I think it would be best to not do that to existing tenants and only do that if a tenant moves out and a new tenant moves in, to charge a market rate rather than just jacking up someone's rent by 60% within 1 year.
To somebody else, especially as more luxury units are being developed. Oh, and speaking of luxury units, high-income renters have driven most of the growth in rents since 2010, and that means as high-income earners look to downsize, relocate, or move somewhere else to save some money, they are driving up the average cost by paying more, and that, of course, is reported in a lot of the articles that we see. This all suggests that overall, if you're a tenant who stays in the same place, the chances of your rent increasing by more than 3% is unlikely. And if you do have a rent increase of more than 3%, having unrestricted access to more housing supply would help you negotiate a better price. The only solution for lowering rents is to simply add more supply onto the market through tax incentives for builders to construct more units or less restrictive zoning. That's it. For some reason, politicians love...
Back in 2022, I lost 2 very important people in my life. Big figures. It really wasn't until February of
to complicate something that is really just as basic as simple supply and demand. And for this, if Congress makes it financially viable to build cheaper units, people will build cheaper units. Plus, to make matters even more confusing, realistically, none of this is going to be passing through Congress, and it's purely political posturing to try to either gain votes or make the other side look bad. That's the government for you. But in terms of what Jerome Powell just said a few hours ago on the state of the economy, here's of course what you came for. In terms of what Jerome Powell just said a few hours ago, overall it was a lot more positive than his past meetings, even though he didn't come out directly and say,
we're going to be lowering interest rates at the next meeting.
He did give us some clues that give them the option to reduce interest rates if the data continues to look good and if they determine it's the right choice. For example, the labor market is slowly beginning to soften, with fewer job openings than there were before, and that could be a good reason to pivot. Inflation is on a downtrend, meaning the Federal Reserve is doing a good job keeping it under control. Obviously, they're not going to outright promise a rate cut at some point in the future, but it is looking rather optimistic, assuming all data points are in the right direction, and as of now, that's looking to be on September 18th. All of that just means that the door is now open for a rate cut, but they're not going to know 100% until a few days before. I mean, they still want...
Rate cut will most likely be a quarter point. If he really wants to go crazy, half point. But I think if he does a half point, it's really going to stimulate the economy almost a little too much, just because I think people will price in rate cuts going at half a point out a lot quicker. The thing is, though, there's just a lot of, like, I was talking to one of our loan officers yesterday, and he was telling me that there's just so many mortgage companies that are just barely holding on. And I know I've been watching the commercial real estate market from afar, and there is a lot of pressure on loans coming due and loans coming up, where when they refi at these higher rates, and especially with what's gone on in the commercial real estate market, it is going to be really tough. There's going to be a lot of people who are underwater. So the Fed is teetering. They're really like towing the line. They're teetering on this edge of where they want to get inflation under control for the masses, but they also don't want to send necessarily like the commercial real estate market or any of these subsidiary markets that really rely on what the Fed rate is. They don't want them to go under, because if those go under, it can create this domino effect where it ends up hurting a lot of different areas of the economy and creating more damage overall. And again, Jerome Powell's shooting for a soft landing. So ideally, once this inflation is handled, we're on approach with where it is at right now, theoretically, if rates get lowered. And, honestly, I think if he started lowering rates September, October, and started lowering them even at a quarter point, if he did one rate cut every quarter over the next 2 years, I think that'd be enough for a soft landing. Again, I'm not an economist. This is just my feeling, just my opinion. They might need to go a little bit faster. I think it also really depends how the election goes this November and how the market reacts to that as well. And the reason why I say a quarter point over the next 2 years is just because I think there's a lot of upward pressure on the market, especially in these tech stocks, because everyone is viewing this AI revolution as such a gold rush. Whether or not it is a bubble, I think that's going to take 2 to 5 years to really find out when we start seeing like the use cases, and if people are really willing to pay these extra prices for added productivity with AI products. That being said, we're at this point that's really interesting. We're circling, we can see the ground. And the real question is this landing going to be soft? If we land, are we going to end up doing a touch and go where the economy just takes off again and the Fed's going to have to raise rates? Are they going to let the economy run when they land the plane? All of these different questions remain yet to be answered.
Inflation to subside even more than it already has. They want to make sure the job market stays strong, which so far is pretty good. And according to the governor of India's central bank, there's always going to be the temptation to say, well, if we really want a soft landing, we could start cutting rates now because we've been in restrictive mode for some time. And even after the Fed cuts, policy may remain restrictive. Or in other words, even if we get a small rate cut in September, rates are still relatively high compared to where they've previously been. So don't expect things to get magically cheaper overnight or to see any major changes in the market. We're also going to have to pay very close attention to their September projections, which is likely to give us a lot more definitive guidance in terms of what they expect to happen. So overall, this meeting was really just more of the same. Jerome Powell reassures everybody that they're going to be data dependent, take it slow, and then make their decisions meeting by meeting. But it does appear as though all indicators are pointing to a 25 basis point rate cut this September. And if that happens, it'll be the first time in more than 2 years. Although I personally believe that even if we do see a rate cut, they're going to take it extremely slow, only cut when they're 100% certain that it's the right time. And that most likely means we're going to see higher interest rates for longer than people expect. It's not just going to be a quick race to the bottom. I just think this is probably going to be something that'll take another 1.5 to 2 years to normalize, or at least get to a point where the Federal Reserve rate hovers somewhere around 3.1%, which is currently something that they project to happen around 2026. That's also why, if you would like to see the update on September 18th,
2 years. Yeah.
make sure to subscribe so you don't miss out on that, and let me know what you think down below in the comment section. I'll do my best to read and respond to as many of them as I can. Thank you so much. I hope you found this helpful, and until next time.
So just like so much information there, and it's really hard to tell. And again, you'd have to do a lot of research. I'd be really interested to actually see. Maybe I'll have to dive into it in a separate video. But seeing how the economy actually performs in either a downward recession or recession recovery during presidential election cycles. I don't think it's happened too often because the dot-com bubble happened after Bush was elected. Well, the recession really kicked in 07 and 08. Again, last 2 years of Bush's presidency. Then Obama was elected, came in, was sworn in January of 09. Again, really hard because at that point, if I do remember correctly, the thick of it in 08 had already happened, and they'd already done a lot of the stimulus. I know Obama then ended up providing some additional loans to companies like GM, going back further to like either Nixon or was it Herbert Hoover during the Great Depression. Again, I don't have a good memory of those. I was not even alive, let alone at an age where I could remember any of that, or at an age where I could remember, let alone alive would be the accurate way to say it. So again, it would require more research on my part to really see where those presidencies were in regards to the economy and the recovery of the economy. The other thing is modern monetary theory really didn't exist prior to the 2000s with the dot-com, really since, the 90s when they started with the quantitative easing, the funds rate, and being able to really control the economy between how much money they print and the rate they charge to borrow those funds. So to conclude, I kind of think the housing market is going to be a little warm, not hot. I think we're probably going to see somewhere between 3 to 5% in good markets across the U.S. once rates start coming down. We have seen a level off. And again, the job market has leveled off as well. But depending on how the election cycle goes, how the economy takes it, if it goes good, I would theorize we're going to see at least 3 to 5% GDP growth just because of increase in productivity from a lot of these AI companies and features that are currently being rolled out across the U.S. economy. The other thing is there's a lot of investing in manufacturing going on here in the U.S. If Trump gets elected, we're most likely going to open up more natural resources for better or for worse across the U.S., which could also lead to another type of a blue-collar boom where there's a lot of jobs that are necessary to drill the wells, make the mines, build the pipelines, build that infrastructure, right? And that can also transfer into the financial markets because someone has to fund it. If Kamala Harris ends up winning the election, I think we'll most likely see more of the same in regards to the tech market that we've seen under the Biden administration. He did do the CHIPS Act and has pushed a lot of companies to bring back manufacturing as well, especially in the technological area, more for national defense reasons, rather than Trump pushing people back just for economics and for tax cuts if they manufacture in the U.S. Kind of those two weapons they used were different. I think Biden, and I have no idea on numbers, this is just me theorizing and I'd have to look into it, Biden may have done more in regards to bringing certain types of manufacturing back, definitely related to chips. Overall, it'd be really hard to tell. I'd be really interested. I might have to do another video detailing that because that'd be really interesting. Again, we're in a really interesting point with this election cycle, with the economy, with the trends, with all of the investment that's gone into the U.S. And again, a lot of it's been in chip manufacturing, and a lot of that manufacturing isn't going to make sense unless we were able to increase our power production in the U.S. electric and the U.S. grid, because we're going to need to probably double it between EVs and the compute power we're going to need for crypto, AI, just everything as far as where the economy's headed. It's a really exciting time as well, because if you look at it like the trend towards EVs, we're going to have cleaner and cleaner air theoretically. We're going to have issues with disposal of EVs and the batteries. Theoretically, though, we'll be able to come up with really good processes, and there will probably be industries that are solely geared to recycling those batteries, a lot like recycling cars and scrap metal companies do now currently. So we live in a really interesting time where we're seeing a lot of new technologies really take hold in the U.S. There's a lot of development and investment there. I think whoever wins the presidency, and here's the other thing, at the end of the day, Republican or Democrat, you can't let whoever's president determine your life. I've watched it affect people for the next 4 to 8 years of their life. You can't give up that much of your life if you want to be successful in business. Again, this is a super long rant, but if you take anything away, don't let whoever's president stop you from being successful. It's just not worth your time. It's not worth your energy. And at the end of the day, the most important thing is that you chase your dreams as an entrepreneur. You create products that add value to society, and you scale your business, right? And you got to do that regardless of who is the president or who controls Congress or who's on the Supreme Court. So that being said, this was a long video. This was a lot more, I dare say, political than a lot of my other videos. Obviously, I try and keep it as neutral as possible. For you guys, I really despise it when I see people that are incredibly biased. That doesn't mean I'm not going to speak my mind on it. And especially if I have certain disagreements. However, as far as the economy goes with whoever wins, I think there's more, I think people price in a better economy based off of a Trump win, even though it could be rockier depending if he does what he's talking about with tariffs and tax cuts. If he just does the corporate tax cut, I think that's fine. If he does tariffs, that's going to be more rocky. I think if Kamala wins, we're probably going to see a higher corporate tax rate across the board. Most likely because I do believe the Trump tax cuts will expire here in the next 2 to 3 years. Anyways, again, this dives into a lot of things. I don't have the exact numbers pulled up in front of me, so I can't give you guys accurate numbers. Anyways, if you want to see more about this, more about the numbers, please just comment down below. That way I can actually make videos on it if you guys are interested in it. And always, please subscribe to the channel. It helps me a lot make more videos like this for you guys so you can grow your business and invest the profits.